Hey, deal makers, welcome to the show where it's all about financial freedom with real estate. Let's do this. All right, today's episode, we're going to talk about raising capital, how to use other people's money to build your real estate empire, like the way that Robert Kiyosaki talks about in his purple book, Rich Dad, Poor Dad. But you don't want to do it with, by begging your friends and family. And so many people kind of struggle with this conceptually, even before they get going, because of various limiting beliefs they have or false beliefs they have about raising capital. They've never done it before. They don't want to beg their family and friends. They don't want to lose people's money. They don't even know what to say. And so as a result, they make a lot of mistakes along the way. And so I want to talk about those capital raising mistakes that people make so that you can avoid those mistakes. And one of the things about raising capital is that, of course, it opens up the universe to real estate, because now your ability to buy real estate is only limited by your ability to raise money. And the good news is that you can learn to raise money in about 30 days. It's not really that hard conceptually to raise money. And within 60 days, you're actually getting pretty good as you're talking to more people. And you can comfortably raise $500,000, $1 million, $2 million, or even more simply by meeting with people one-on-one. But there's so many different mistakes that people make, right? They struggle with raising capital because they try to go online. They think that raising money online is the easy button, and it's not. Or they wait to have it until they have a deal under contract, and they then raise money and they can't raise it fast enough, and so they lose their EMD, their deposit, or they assume that they have to raise all the money themselves. And so what happens is a lot of people fall short, and they kind of never do a deal, and they go away and they say, see, can't be done. And so I want to talk about here some of the top capital raising mistakes that people make. So the first several mistakes I think are limiting beliefs around raising money. And so one of the things I hear all the time is, I can't do it. I've never done it before, therefore I can't do it. Now, I don't know about you, but just because you've never done something before doesn't mean you can learn to do it, right? And I'm sure there's many things you've done in your life and your career that you've learned to do. Probably, arguably, everything you've learned at one point you've never done before. And so why would raising money be any different? Why couldn't you learn how to raise money? And the truth is, like I just said, you can learn. Dozens, hundreds of people learn how to raise money. All of our students have learned to raise money, and they've never raised money before. So clearly, it can be done. I hear limiting beliefs around, I don't know anyone with money. Okay, well, that may be the case. I mean, some people know people with money and other people don't. But the thing is, your ability to raise money is not limited by the people you know. It certainly starts there. In fact, when you first start learning how to raise money, you're going to talk to people that you already know, because they're going to have a conversation with you, right? They presumably like you, and so they'll have a conversation with you. They might say, I don't have any money to invest, but they'll have a conversation with you. Number one, you will get practice by talking with people about pension investing. And number two, they might know other people as well. So just because and then number three, there's some people that you think doesn't have money, and they kind of do. It's the millionaire next door, right? If you read that book, The Millionaire Next Door, a lot of people who look like they have money literally are living paycheck to paycheck. And people who appear to be poor have $1 million in the bank, right? So don't judge people on whether they have money or not. You're always going to talk to people. And so whether you know people with money or not doesn't really matter. You got to start with where you are right now, because you're going to, over time, expand that network. The mistake I also see people make is trying to use sales tactics to raise money. Or more importantly, they're thinking they have to use sales tactics. They think they have to learn sales and kind of figure out how to manipulate people or beg people for money or use other tactics to try to raise money for them. And so my advice from that mindset is you don't need to do that. So stop trying to raise money. When you're talking to people, okay, just remove the need to raise money in that conversation. You maybe have been to a networking event, right? This drives me crazy. You meet someone for the first time, and they shove a business card in your hand and they pitch their wares, right? I'm like, that's awful. What's a better way to network? For example, this is what I'm talking about. A better way to talk to people in general is leave them with a positive first impression, right? So when you're in a conference, for example, you're just going to have a positive conversation. You're not going to push your agenda. You're going to just leave a positive first impression. So when you follow up with them, they'll remember you positively and they'll agree to the Zoom call. Same thing when raising money. It goes a little step beyond that, because really what it is, instead of you selling someone, what you're really doing is you're really educating people. There's a huge shift. And it even starts by as simple as sharing your enthusiasm, right? Because here's the thing. You got to understand people with money. They also have problems, okay? They maybe have different problems than you do, but they still have problems. Let me share with you that what some of those problems are that you can help with. People with money they're typically their only option is investing in a stock market, equities, and bonds. Okay, that's what the financial advisor does. You can buy ETFs, mutual funds. That's what you do, right? And so, what are the problems with investing in the stock market? Well, one of them is that the returns it's volatile, right? The returns are volatile. Now, over the long run, if you look at a 20 plus 30-year graph, it's always going up. And when you zoom in, especially on a 1 to 5 year level, you'll see it chopping around a little bit, right? And so this is a problem when I as an investor, I'm trying to do some financial planning for my family, and I'm building up a 529 for college, or I'm building up a 401k or whatever to retire, let's say, and now I actually want to have a kid going to college, and now the market is in a 15% correction. Well, it's stupid to try to start selling for my 529, but I have no choice because I need the money for the college, so now I'm selling at the wrong time, right? And so this makes financial planning very, very frustrating because it's not just an overall 10%, even though the average return is 10% over the market, let's say over 30 years, it's not an actual linear 10%. If I had a linear 10% compounded return, my returns will be much higher. But if you actually do the math, and let's say it goes up 15% one year, and then it goes up 7% one year, minus 5 another year, but overall it's 10%, the overall return actually is much lower because of the volatility. So that's frustrating. Number two, the stock market typically doesn't pay cash flow unless I have a lot of money and I'm doing very advanced option strategies, or I invest almost everything in highly dividend producing stocks, which in a diversified portfolio is not really done. So your cash flow is limited, right? And number three is you're paying taxes. Every time you sell something, you gotta pay capital gains. And so this is why a stock market investor might be scratching their head going, what else is there out there? Is there maybe some other investment? And the one investment that investors always come back to is real estate. And what they normally do is they'll go buy a rental property. They go to rental property and they realize what a pain it is. It generates $100 a month. It's a giant pain. And they're like, this is for the birds now, right? And so you can help them with all of that. You can help them get into something that the returns are much higher, typically 15 to 20% average annual returns. It has cash on cash return. So if they invest enough of it, they can actually exit whatever they're doing. It's got passive income. And number three, it's got tax advantages, right? It's got tax advantages through depreciation, but also through 1031 exchanges and things of that nature. So if you say, hey, you're not going to believe what happened. I'm getting into these apartments. It's really exciting. I'm working with an experienced a mentor, and the minimum is $50,000, and it's a 15 to 20% average return. It's got a 6% cash on cash return. And it's got amazing tax benefits where investors typically don't pay any taxes while they're holding a property. And then you say, hey, do you know anyone who might be interested in conversation? Like, that's capital raising right there. You're educating them. You're sharing your enthusiasm. And so people who are of that nature going, hey, is there anything else out there? I'm not looking to replace my stock market. I'm looking to diversify in something that's a different risk profile that does something different. They're going to lean in and they're going to ask you questions. All you have to know now is you have to educate yourself about the real estate investing asset class, right? Which is easily done. So you can explain how this thing's done, how you can passively invest as a limited partner, what that means, what the returns are, what the risks are, things of that nature. So really get it out of your head that you need to use sales tactics to manipulate people investing with you. It's really about sharing your enthusiasm and then educating people. Okay, now that I kind of talked about some of those limiting beliefs and some of those in your mind about, oh, I can't raise money because I never have. I don't know anybody with money. And then being afraid they have to use sales tactics to manipulate people into giving you money. Out of the way, I see some other mistakes that people make as they're trying to raise money. One of the things I see often is that they feel like going online will raise money. Going on social media will raise money. And there's in fact programs out there that are doing very well. They are selling the easy button, right? Everybody wants to go on social media and have $1 million raised. But the truth is, who's actually really successful in those programs, right? Especially if you have never raised money before, you're not going to be successful because you can't actually go online and raise money because you don't have any trust with people. You really have to learn to raise money one-on-one first. Now, you may not want to hear that, okay, but it's the truth. I've been doing this for over 11 years, and you've got to learn how to raise money one-on-one first. Now, it's not very scalable. I'll tell you how to scale it later on here in the show. It's not very scalable, but it's really important. Why is that really important that you have to learn how to raise money one-on-one? First of all, you have to start knowing what the investors want, what they're afraid of, what questions they're going to have, what concerns do they have, right? How are you going to know? How are you going to amplify a message online if you don't even know what the message is? Also, what you want to do is you really also want to know over time, if you're going to go online, you have to get very clear on who your avatar is in marketing speak. You have to know who you're speaking to, right? In the beginning, you're speaking to anybody who wants to talk to you, right? There's no clear avatar. But over time, and this is why time is important, reps is important, which of the investors resonates with you more, right? If you're an engineer, for example, you're going to resonate with other engineers. If you're a medical doctor, you're going to resonate with other medical doctors. If you're a professional athlete or a former professional athlete, well, guess what? You're going to resonate with other professional athletes, right? So who are you going to resonate with? Who is your ideal investment avatar? And if you're going to go online, you better know that. Otherwise, your message is lost in the wind. So don't think that you can go online and simply raise money very quickly. Now, the good news is you don't actually have to go online early on to raise money, because I said earlier, a good number of our students raise $500,000 or more, right? We had Ryan Kindred and Russell Cannon calling them out right now. They raised $2.1 million for their first deal. I had Scott Todd raise $800,000 recently, and these are all first raises. This is pretty amazing, right? So you can raise a good amount of money one-on-one, right? Simply by educating them, by providing value, by staying in touch with them, building trust, things of that nature. So you don't have to go online in the beginning at all. Now, again, I'll talk about that in a second, going online, but not in the beginning. It's a mistake I see people make, and they don't raise any money at all, and they've wasted months of their time. Here's another mistake I see people make. They say, well, if on the right deal, you get the right deal, the money will follow. You know, that's a crock of crap right there. It doesn't happen, because when you get a deal under contract, you get like 60 days to close it. You're not raising $1 million in 60 days if you've never done it before, right? If you've done it before, maybe you can, but if you haven't done it before, you cannot. It's just simply not enough time. I remember a conversation with a guy, let's call him John, because that was his name. And John's telling me the story about how he lost $30,000 on a deal he couldn't close. John, why couldn't you close the deal? Oh, I couldn't raise enough money. Oh, John, when did you start raising money? Well, when I got the deal under contract. Well, John, my friend, now he was not working with us. That is too late to start raising money. Now you might say, okay, well, how do I solve this chicken and the egg problem? If I don't have a deal under contract, how can I raise money, and vice versa? It is what we call in our world the sample deal package. Sample deal package is an investor package that has everything in it. It's got an actual photos, a deal, it's got financials in it. And it's a real investor package, except for the fact that you don't actually have it under contract. Now, you tell your investors you don't have it under contract, but it is a conversation piece. And this conversation piece allows you to raise money now, long before you start making offers. And so now you sit an investor down, you use it as a conversation piece, and you say, hey, this is not a real deal, but when I get a real deal, it'll look substantially like this. So let's pretend it is for a moment. And because when I get a real live deal, things move really quick. Like, we don't have the time for you to ask me questions like, why should I invest in multifamily? Why should I invest in you? What's your track record? What are the risks? Blah, blah, blah. All this will take time. And so what you want to do is get that out of the way first. You get the big questions and objections out of the way first, up front. So when you get a live deal, you send them the real deal package. Okay, now they might have some questions about the deal. Okay, but they're not going to ask you the big questions, the trust questions, the questions that take a long time to answer. You've already done that. They're going to ask you a couple of questions. They're going to go, okay, cool, because I already asked those big questions. And now you can simply raise money, millions of dollars in days. That's how you do it. And that's how you overcome this particular objection about how can I raise money now? Because imagine if you do this now and you have 5 people who give you what's called a soft commit, $50,000 each. That's $250,000. Like, how much confidence would you have putting a contract on $1 million building, right? A lot. Versus you going in there without any soft commits behind you whatsoever. And now I'd be biting my nails. Now, John was biting his nails. I mean, I applaud him for trying it, but it's unnecessary. So use a sample deal package and create an investor package up front, and then use it as a conversation piece. Or here's another mistake. I hear a lot of people, hey, I try to raise money. I could barely raise $150,000 and I'm tapped out. I don't have anyone else in my friends and family network. How do I now find new people? Now there's other strategy you can use to find more people. You can certainly go to networking and blah, blah, blah. Okay. But the low hanging fruit is get referrals. You're not getting referrals, right? So there's a Cutco knives. You may be familiar. Maybe you have one in your house. My partner, Garrett Lynch, on the Nighthawk equity side, he actually spent a couple years in Cutco. And what they teach you is to always get referrals. So when you go and show a bunch of knives, you have an appointment, you never leave there without referrals. In fact, Garrett always would ask someone for 10 introductions, 10, and they would go, "Oh my gosh, Garrett, I can't give you 10, but how about I give you 4? Would that be okay if I give you 4? 4 referrals? Are you kidding me?" Now, look, simple math. If for every person you talk to, on average, you get 1 referral, you never run out of people to talk to. So you have to get referrals. You don't have to go to any networking event. You never have to go on social media at all. If you do this one thing, just get referrals. I mentioned Ryan and Russell earlier, who raised $2.1 million, and I'm working with them right now. And because they're scaling their portfolio, right? They've got this great $4.6 million deal. I want to help them get to $100 million. And so they're like, "I'm tapped out, Michael. What do I do?" And I told them this very exact thing. So what they're doing is they're going to start a reach out campaign. They're going to talk to their existing investors after they send out the first distribution, of course. And they're going to say, "Hey, since your distribution, hey, can you give me a handful of people that you can introduce me to?" And it's not just name and number. What you want to do is you want to get them to introduce you with an email CC to you or a group chat. You don't want to just get their name and number. You want an introduction from them personally. That's what you're looking for as well. So they're going to do this reach out campaign. They're also going to reach out to investors that they have not invested. That's okay. "Hey, I'm calling a couple things. Just want to make sure, hey, we're still working on a deal, but I know we had a really good conversation. You didn't invest, the last deals. That's okay, but can you introduce me to like a handful of people that might be interested in a conversation?" So what I'm saying is get referrals. Do this one thing and you'll never run out of people to talk to. Here's another mistake: not staying in touch with people you talk to. And I certainly did that as well. I remember I did in 2018, it was a $1.6 million deal in Birmingham. And I had a sizable list I had created, but I really wasn't talking to that passive investor list. I had some kind of lead magnet and people got on it, and I never sent out any content to the passive investor. Now, at the time, on the educational side, I send out plenty of content for the educational side, but not to my passives. So I tried to do this webinar deal, and it was crickets. I could barely raise a $650,000, and I learned the lesson that you have to stay in touch with your investor. Now, at that point, I'd already been online. We'll talk about that in a second. But what I find a lot is that people have the first conversation with an investor, which is hard to get. You're reaching out, and now you finally get a meeting or a Zoom call with them, and you're talking through the sample deal package, and then you let them go. You're not staying in touch. You got to stay in touch. But how to do that, right? You can do that when you have 10 investors, but what if you have 100? Well, maybe you can do it 100, but it starts getting more difficult. So here's how you do it. Go ahead and create an email newsletter. You can use an email system like MailChimp or ActiveCampaign. Just look out there. Go High Level is another one. MailChimp seems to be the most affordable one. It's very affordable. You can create an email list, and you can send an email out to those people on the list. Every time you have a conversation with someone, you drop them on the email list, and you send them a personal email. "Hey, thanks so much for your meeting. I put you on our newsletter so you know what's going on." And then once a month, or ideally more frequently, but let's start with once a month, you send out an email. You send out an email about, "Hey, what's going on in your world? Hey, I looked at a deal. It didn't work out. I want to make sure we're doing a good investment together. Here's this cool article about commercial real estate in the Atlanta market," or whatever. Okay, so you're providing value, you're staying in touch. So the idea is that when you do actually get a live deal, let's say it's only in 3 months or 6 months or 9 months, doesn't matter, you've been staying in touch with those investors. So when you get on a live webinar, you've been staying in touch, you've been nurturing that relationship. Send them a text every once in a while, right? Create a system where you're sending a text or maybe a voice message or even a call every so often. And so definitely make sure you stay in touch with your investors and nurture that relationship. Here's another mistake I see people make, and that is ignoring IRA money. I remember when I first started raising one-on-one a while back, I had a conversation with my neighbor. I actually set a lunch meeting with him, and I went through all my spiel. This is another example of one-on-one meetings, is you already know what they're going to ask you, so your spiel gets a little bit longer because you're trying to proactively address questions and concerns, because if somebody has too many objections, guess what? They're not going to invest with you, right? So you want to limit the number of big questions and concerns they have. So I'm going through my pitch, because he had a big house, he had a big car, 2 big cars, 3 big cars, and he goes, "Man, I got and the minimum investment time was like $50,000. And I was like, minimum investment is $50,000. He goes, "Man, I got like 20 liquid right now." I was like, "Oh man, I just wasted 40 minutes pitching this guy, and he's got no money to invest. I should have asked him in the beginning if he had money to invest," which of course is a bit rude, Okay. I said, man, Scott, shucks. Well, let me ask you this. Do you have like an IRA account or something like that? Oh yeah, I got like $500,000 in the IRA account. I'm like, oh my goodness gracious, I'm such an idiot. And so a lot of people have a lot of money in 401ks and IRAs. So make sure you educate yourself around how someone can invest with an IRA. I'm not going to go into details here in this podcast. It's a little bit beyond the scope of that, but you can Google how to invest your IRA money in real estate. But the point is you use something called a self-directed IRA. It's a specific kind of account, an IRA that you open, you transfer your old IRA money into this other account, and then you can literally do stuff with it. You can do promissory notes, you can do hard money, you can buy stuff, you can invest stuff, and there's a lot of money in there getting like 5% per year that people don't know they can invest. And so this really helps me and helps us unlock a huge amount of capital when otherwise people don't have a lot of liquid funds. Now here's the good news, okay? You don't have to raise everything yourself. This is another big mistake I see from people who are even thinking about and resisting the idea of raising money online because like, oh no, I'm not raising money themselves. They're like, there's no way I can raise $1 million. Okay. And maybe you can't the first time around. A lot of people can't raise $1 million, or they can maybe raise $100,000 with some effort, but they can't raise $100,000. But they're making a bit of a mental mistake. And what I see a lot with capital raising and multifamily in general, people ask a lot of how questions. How do I do this? How do I find the right market? How do I find the right deal? How do I analyze a market? How do I talk to brokers? How do I raise money? A lot of how questions. The thing about the how question is several. After every how question, there's 3 other how questions as well. It actually won't really make you move forward with regards to getting into this business on the one hand. But number 2, really, the how questions can easily be answered. And it can be answered by a bunch of who's. So there's a book by Dan Sullivan called Who Not How, and I talk about this a lot. And you really got to get away from asking how questions to asking who questions in general. And it's specifically also to raising capital. So yes, you're asking, how can I raise capital? You should ask that question. You should always raise capital. But an even bigger question to ask yourself is, who can help me raise capital? And you're like, what are you talking about right now? Well, would it shock and surprise you that in our world, in the world of syndications, there's deal finders and capital raisers? Okay, here's what I'm talking about, right? So the deal finders are people who are typically more numbers oriented. Maybe they're former engineers or CPAs or finance people. They're more numbers oriented. And so they gravitate to deal finding because they can analyze with deals and get deals done, etc. But then there's the capital raisers from a personality perspective are much more relationship oriented, and they don't really like numbers. They're big picture people. They don't like spreadsheets. So people who are like that will resist the idea or of analyzing deals because they don't really like it. They're not really good at it. They don't like doing it, but they are good at talking with people. And so those are the capital raisers. You need both in the syndication. This is why joint ventures between a deal finder and a capital raiser are very common. In fact, I keep bringing up Ryan because I recently just talked to him. Ryan and Russell are exactly that joint venture. This is why also they're so successful, is because one is focused on deal flow and asset management, and the other one is really focused on raising capital. So one person is focused on one thing and the other is focused on the other. You put them together and 1 + 1 is far greater than 2. So what I'm saying is, in a syndication in the world, in an ecosystem like ours and others, there's a number of capital raisers in there who have access to capital and the personality to do it. What they don't have is access to deal flow. And that's where the deal finder comes in. So if you're more of a deal finder, you're like, I'm really struggling raising this capital thing, you don't have to raise all the capital yourself, right? You're finding the deal that's very valuable, and you'll raise $100,000, $200,000, and you're going to bring in a joint venture partner into the partnership, and that other person is going to raise the remainder. I brought up Scott Todd earlier, he raised $800,000 for another operator. That operator found the deal, raised the capital, but was short $800,000. And so Scott brought that to the table. The same thing works for you as well. So don't think that you have to try to raise everything yourself. In your mind, start to network with people, right? If you're a capital raiser, then for deal flow, start looking for deal finders. If you're more of a deal finder, then from a networking perspective, look more for capital raisers. It makes your networking much more precise and targeted, right? So if you're a deal finder, don't target with another deal finder. It's not going to help you, and vice versa with a capital raiser. So don't try to raise everything yourself. I learned this from this Birmingham deal that I struggled to close when I raised the $650,000, yes, I started talking to my passive investors. That helped a lot. But I did not know and appreciate this whole idea of partnering with a capital raiser. So a year later, in 2019, we bought a $9.2 million by doing exactly the same thing I'm talking about. We raised $3.2 million. Now of that, I raised about $1 million. And this other partner raised the rest. That allows us to get into a 321 unit deal in Memphis. So don't think you have to do everything yourself. And make sure that in your networking, as you get into this business, you're thinking about that as well. And here's the last mistake, and that is not scaling by raising money online. Finally, we are here, right? But a lot has happened. You've raised $1, $2, $5 million just up to this point. You don't actually have to scale online at all. Now, yes, should you go on social media and post and build a platform somehow? Yes, but don't expect it to raise a lot of money, because you're going to do it one-on-one by bringing on people, getting referrals, staying in touch, nurturing that relationship, bringing in a partner as well. But once you've raised, $3-5 million and you want to 10x that, you want to go from raising, 3 to 5 to 10 to 20, you have to get the conversation online. Now, I'm not going to get into this right here. I'm going to do a whole new separate podcast on scaling the money online, because very few people have raised $5 million. Listen to this right now, and showing how to get to $50 million isn't really going to help you. But short Cliff Notes version of that is exactly when you start raising money online. But again, mistakes are being made as well, because just putting up a website doesn't raise money. You just posting stuff on social media is not raising money, right? You've got to have a real system, a platform, an automations platform built up to raise capital. So first thing, you need to be very clear about your avatar. Who's your avatar? So you know who to talk to them. We talked about that earlier. Okay. You also need a way to capture leads and build your email list. So you need a lead magnet, a free download, that's something of high value that your avatar is willing to give you your email address for. And then you need to commit to producing content on a weekly basis to accelerate the trust building. And that's how you then do a webinar and raise millions online. And now you're more concerned about generating leads, where you're getting on other people's podcasts, driving leads back to your lead magnet, creating your own podcast, doing a book, investing in paid traffic, things that are all driving back to your lead magnet. That's how you do that. And we'll cover that in a separate podcast. But I want to talk to you about some of these mistakes I've seen people make, all the way from I can't do this, and then when they actually start getting into it, they make a lot of mistakes. So hopefully you guys found that very valuable in your own journey and opening up what's possible, and when you're actually raising money, being able to raise all the money you need for your deals. Now, if you want to learn how to raise money yourself, and you think you can actually benefit by working with someone who's raised $10+ million, then maybe book a call and explore what that's like to work with us. The next thing you can do is go to thefreedompodcast.com and you can book a call with us. If you're still pretty new to this whole thing about idea of getting into apartments, then on thefreedompodcast.com, you can also access our free training class called Apartments 101, and just watch that as a 45-minute training video as well. Now, if you're listening to this going, hey, that's just really cool, but I'd rather just I'd rather just invest passively, then also go to thefreedompodcast.com, learn more about investing passively. We have a free mini course there as well. But if you are looking for opportunities right now, then you can also book a call with us at Nighthawk Equity, and we can present you with some of our investment opportunities. So either way, we want to help you take that next step in financial freedom with real estate, so that you can do that at thefreedompodcast.com. So one of the biggest differences in single-family house investing and multifamily is a who, not how mentality, like we talked about before, just in everything. But the big aha moment for me was raising capital, right? So really figure out how you can raise capital. It's an absolute game changer. Whether you're a deal finder, it's going to be a little harder for you to raise capital. You're going to partner with capital raisers, but it is an amazing skill that you can build. So make sure you educate yourself before you do that. Build your team around you. Start using some of the right words and learn how to raise capital and talk to potential investors. It's really an amazingly awarding experience. So hopefully you're inspired by that. Let's start raising some capital. I'll catch you in the next episode.